Volatility in dollar yen has picked up once again after speculation that Japanese officials may have intervened in the market secretly. Hello and welcome back to our channel. My name is Daniela, and in today's video we're going to be talking about dollar yen because we've seen action from both central banks in the last week, and we've also got speculation, as I said, about FX intervention from Japanese officials. But before we get into it, please like this video, comment, subscribe, and if you have any questions or suggestions, feel free to leave them in the comment section below. So as I was saying, the US dollar yen pair has been quite volatile in recent days. And we'll look at the chart in just a second when we talk about the possible intervention from Japanese officials. But let's do a quick recap of the two central bank meetings that we've seen. So on Friday last week, we saw the Bank of Japan keeping rates unchanged. Now, we had seen previously the Bank of Japan end their negative rate policy in what was widely expected for markets, but something that took a long time to actually deliver. And we knew back then from the commentary from Governor Ueda, there was likely a one and done situation. Nonetheless, there were still hopes in markets that we could see another hike from the central bank to stem the weakness in the Japanese yen, but that was not the case. Rates unchanged, and Governor Ueda actually saying that the impact of the weakening yen on inflation was actually marginal and not enough to see another hike from them. So that, of course, putting some further weakness on the Japanese yen, and that's when we saw the pair spike higher once again. Dollar yen breaching the 160 mark for the first time, I think, in 34 years, so a 34-year low. Now, we did see a rapid move after that, especially on Monday, but let's quickly look at the US Federal Reserve to see how the other central bank compares, because on Wednesday, we saw the Federal Reserve again leaving rates unchanged as widely expected by markets again. But in this case, markets were trying to determine how much forward guidance Powell and his team would give in terms of when they expect to be able to cut rates, given the resilience in the US economy and the strength in US data. Now, it's a pretty uneventful event, an eventful meeting, which for markets, it's actually quite positive. We didn't see much volatility. We did see some knee-jerk reactions in equities and also the dollar, but we ultimately saw a lack of updated guidance. Yes, we did see Powell admit that there's been a lack of progress in the last few months in the fight to get inflation back to 2%. And that's what was mainly keeping the central bank from cutting rates, even though they're primed and ready to do so themselves. When asked what the next course of action was, there has been speculation in recent weeks that the central bank could actually disregard all rate cuts and actually have to hike once again, given the strength in the underlying US economy. When commenting about that, Powell did say that policy is sufficiently restrictive, which means that no intention to hike once again. This means that the next move from the central bank is expected to be a cut. It's just a case of when that cut is going to be able to be delivered. Now, updated pricing after the meeting actually has pushed that back once again when those expectations are currently 35 basis points of cut priced in for 2024, down from 40 prior to the meeting, and 23.8 of that priced in for November. So it does seem like we could see a rate cut in November, but likely that gets pushed back further to December if we do actually see further strength in US data. So for now, the key takeaways from the Fed meeting is that no intention to cut just yet, given the resilience in data and the fact that the progress towards inflation getting back to 2% has stalled, but also don't see any need to hike rates once again, given that policy is sufficiently restricted. So all in all, not the most eventful meeting, but it did provide a little bit of direction for markets. We have seen some consolidation from the US dollar in the past few days, a little bit of weakness after Wednesday's meeting, given there really wasn't a hawkish tone to it. But let's take a look at the chart now. Okay, so let's look at the charts. Dollar yen we'll be looking at, of course. And I just want to highlight what I was saying earlier at the beginning of the video, the fact that there has been speculation that there may have been a Japanese intervention in FX markets. We have seen Japanese officials hinting at this for the last few weeks, even months now, given the continued weakness in the yen. As you can see here, the strength in the dollar, pretty much a one-way street here from the beginning of the new year. We did see a little bit of a dip back here in March, but all in all, it's been a pretty straight line towards that 160 level that was breached earlier this week. Now, the fact that dollar yen breached 160 and rapidly did a 180 turn and went back down to about 154 did spark some, as I said, speculation that Japanese officials may have intervened in the market this time. We actually haven't had official confirmation yet. In fact, we've seen officials saying that they will not own up to any intervention over the last few days. But that isn't something that's really new. It isn't surprising. Sometimes these surprise interventions are done with the hopes of keeping investors guessing and creating a little bit of hesitancy when it comes to the continued devaluation of the yen. So the fact that they haven't confirmed this means that any investors looking to now come into dollar yen are likely to be questioning whether there's any further room to push higher in dollar yen, given this ever looming intervention that surrounds the pair. We did think it was good, or there was speculation that would come around the 150 mark, even 151, 152. So you can see we saw a lot of sideways consolidation around that time. Again, a lot of hesitancy from new buyers to come in and push higher, just in case they got caught on the wrong side of the trade. If we did see that intervention and come in, and therefore we saw a rapid depreciation in the dollar like we've seen in the last few days. So it looks like 160 could now be the next area of key resistance for buyers coming in, looking at potentially where to draw the line when it comes to that possible intervention from Japanese officials. As I said, not yet confirmed, but highly likely that that has been the case of what has happened. Where do we go from here? Fundamentally, the momentum still points higher. When it comes to rate differentials, the dollar is still much higher or much more favored than the yen, and therefore it's likely to continue to push higher. Naturally, the path of least resistance is expected to continue to move higher, but technically we had come to an area where we were significantly overbought, breaching that 80 level almost all the way to 90. So it's potentially also good that we've seen this reversal. We've seen the RSI coming back towards that 50 line, towards that, stable and equal line. So we could see new buyers coming in. Again, that 160 area is now going to loom in the mind of new buyers. So we may see some sideways consolidation from here, not really garnering that momentum to push higher. But fundamentally, as I said, path of least resistance higher, where there will be some technical levels to watch out, though, as investors are now hesitant as to whether they expect further intervention from Japan. But all in all, nothing has really changed for the long term here for dollar yen. That is it for today's analysis on dollar yen. Thank you so much for watching, and don't forget to subscribe to our channel.